what's up, guys, and welcome to another installment of 5 Things to Know in the Market Next Week. I'm your host, MIA, and before we get started, just a quick reminder, we are live each and every weekday, 9 a.m. to 4 p.m., so be sure to like this video, subscribe to the channel, and hit that notification bell so you know each and every time we go live or drop one of these time-sensitive videos. Now let's get right into it. All eyes will be on banks this week. Following the SVB, Signature Bank, Silvergate collapses, we had the Swiss government brokered takeover of Credit Suisse by rival UBS that created turmoil all week in the banking sector. And this was highlighted by Deutsche Bank, tumbling over 15% early Friday before recovering, closing down just under 10%. Deutsche Bank is one of the 30 banks considered globally significant financial institutions. So international rules require Deutsche Bank to hold higher levels of capital reserves because its failure could cause such widespread losses. As investors' fears on the sector's health grew, the cost of insuring the bank's debt against the risk of defaulting, which is known as a credit default swap, surged, causing the sharp decline on Friday. So although we are being told the banking system is stable and sound, a lot of signals would beg to differ, so look for more downside throughout the sector as we continue to monitor the global banking system. Next up, we'll be keeping an eye on the Personal Consumption Expenditures, or PCE Price Index, which is the preferred gauge of inflation used by the Fed above CPI because it more closely tracks spending decisions by U.S. consumers. The index is projected to have risen 0.5% last month after rising 0.6% in January. On an annual basis, the index likely rose 5.1%, decelerating from 5.4% in January and recording the slowest annual gain since September of 2021. Core prices, which exclude volatile food and energy costs, likely rose 0.4% compared to January and 4.7% year over year. So with the next FOMC not coming until May, we will look for any numbers coming in outside of these estimates to move the market, as these expected numbers are probably priced in at this point. Moving on, we will be looking at the home price updates. On Tuesday, index provider S&P Global will release its Case-Shiller National Home Price Index for January, while the Federal Housing Finance Agency will issue its House Price Index, which tracks prices of single-family homes nationwide. Home prices, as reported by the Case-Shiller Index, are projected to have fallen 0.9% in January, marking the 7th consecutive monthly decline. Year over year, prices likely rose just 3.7%, decelerating from the 4.6% in December, and marking the slowest annual growth rate since June of 2020. Dun, dun, dun. The U.S. housing market has entered a sharp slowdown in recent months as a combination of rising mortgage rates, falling affordability, and limited inventory weighs on demand. The average rate on a 30-year fixed-rate mortgage currently hovers around 6.4%, up from 4.4% this time last year. Again, look for any deviation from these estimates for any dramatic immediate impact. These numbers do have a lot of indications in the macro sense, however, so something we will definitely be keeping an eye on. And moving on, the fourth thing we'll be looking at is the consumer sentiment reports. This is 2 different reports, with the CB Consumer Confidence Index coming out on Tuesday and the Michigan Consumer Sentiment Index being released on Friday. Now, consumer sentiment is an economic indicator that measures how optimistic consumers feel about their finances and the state of the economy. And in the U.S., consumer spending makes up a majority of economic output as measured by GDP. So, a higher than expected reading should be taken as a positive sign for the USD, while a lower than expected reading should be taken as a negative sign. Projections for the CBI are 101.0 after coming in at 102.9 last month. So we can expect consumer confidence to fall for a 4th straight month, another sign of a tightening economy. And lastly, now this is kind of a twofold, so we will be looking at oil prices as well as some geopolitical tensions. Declining oil prices are obviously a recession fear And definitely one concern with the oil falling under $70 a barrel, as well as the U.S. holding off on replenishing its reserves. The other part of this will be the effects of the Russia's announcement to use the Chinese yuan as settlement currency with countries in Asia, Africa, and Latin America. Now, this could have severe ramifications on the demand for U.S. dollars. It could also allow Russia to diversify its market and reduce its dependence on the U.S. dollar, making Russia less vulnerable to the U.S. sanctions. And in a more general sense, the strengthening of the economic ties between Russia and China could have major implications just in the balance of power in the global economy as a whole. So, a developing story that we will keep an eye on. And that is it for this week, guys. Thank you so much for watching. And again, don't forget to check us out live each and every weekday, 9 a.m. to 4 p.m. Peace out, y'all.